So it was Harry Markowitz that established the concept that's been oft repeated, that diversification is the only free lunch in investing. And the idea there around it, the free lunch, is that with diversification, you can design a portfolio that either increases your rate of return for a similar amount of risk or decreases the amount of risk for a similar amount of return. So that's the free lunch, right? The adding additional uncorrelated asset classes allows you to build a portfolio that's more efficient, that is the highest rate of return for a given amount of risk. Now, there's a huge caveat here, and sort of an unfortunate and disappointing one, and that is that diversification hasn't really worked for a while now. You go back to 2013, and it's really the first time that diversification stopped working through this sort of mega cycle. Now, there have been periods in the past where diversification hasn't worked, and you go through these periods, but our firm view is that over time, diversification definitely does work, and it's a better idea to be diversified. This chart sort of shows the trouble that diversification has had over the past several years, and I'll just kind of explain it. The top part is the annual returns relative to a domestic 60-40. Now, domestic 60-40 we think of as domestic stocks and bonds, and kind of the minimally diversified portfolio that an institutional investor ought to be thinking about. So that is stocks being relatively lowly correlated to bonds. They move in different ways, and bonds being the primary diversifier with respect to stocks. And then, you start with that as your fundamental diversified portfolio, and then you start adding in other asset classes to provide additional diversification and more of that free lunch. So the top part, the big eye chart, shows all the asset class returns on an annual basis relative to the 60-40. The brown shaded regions are when other asset classes were negative relative to that diversified 60-40. And then the bottom row here is color coded relative to the percent of assets that did well or poorly relative to that 60-40, right? So you go back to the early 2000s, the early part of the century, and you can see that a lot of asset classes were beating that domestic 60-40, that minimally diversified portfolio. 70s, there's a 40, 60s. So a lot of the times, the majority of asset classes were beating the 60-40 portfolio up until about 2013, when domestic stocks and bonds really started to do well, and it was really hard to beat just a very simple portfolio. 2013, 60-40 beat 83% of the other asset classes, and up through today. So diversification has really not provided that free lunch for some time now. It's happened in the past where you've had this extended period of stocks doing really well relative to other diversified asset classes, diversifying asset classes. But this has been an extended period where diversification just seems to have not worked. Now, getting that out of the way, let's talk about diversification and theoretically why it should work, right? So lots of studies going back to the Brinson-Biebauer study in the 1980s say that the bulk of returns is explained by the variation in returns is explained by your asset allocation. That is, your asset allocation is what drives your portfolio behavior. There are other things like security selection, market timing, and then some interaction effects, but it's really the asset allocation that drives the behavior of your portfolio. Talking about those building blocks that go into an asset allocation and kind of what they're there for, right? So just think about stocks and bonds, the minimally diversified, the elements of the minimally diversified portfolio, and then other. Stocks are for growth, as pretty much everybody knows, pretty intuitive, right? Stocks go up when the economy is doing good or the economy is anticipated to do well, and go down when it's not. Bonds are your anchor to windward. You get income, not capital appreciation for the most part, and they're there to preserve capital. Bonds are loans to institutional borrowers, anything from the government to corporations, to homeowners and other borrowers to some degree. And then they are supposed to be negatively correlated to interest rates, right? So when interest rates rise, bonds go down. In a growing economy, when stocks are doing well, interest rates are often rising. And so you see that correlation benefit between stocks and bonds, that diversification benefit. In times of severe stress, when stocks are really doing poorly, the correlation of credit, corporate bonds, may increase with stocks. And that makes sense, right? Because you think about it, in a big market downturn, when the economy is doing really badly and companies default, the bondholders become the stockholders. So bonds in that instance become stocks. And as that condition gets closer, the correlation between corporate bonds and stocks may rise, reducing the diversification benefit in those periods. And then so think about, hedge funds, real estate, private equity, those types of things are there for diversification purposes, to reduce risk, in some cases to increase return potential, but mostly there for diversification and risk reduction. Oftentimes they come with low liquidity. Oftentimes they are difficult to value, or more difficult to value than stocks and bonds, which trade on open markets and are valued on a daily basis. Additional due diligence is required to dig into some of the other risks, not just market volatility. The return distributions are not normal, right? They may be skewed positively or negatively. They may have more extreme outcomes than a normally distributed return stream. And then the types are, as I mentioned, real estate, hedge funds, private equity, commodities, and other. And then we talk about how these things act in different market environments. And you can broadly think of the market environments as existing in 4 quadrants around 2 different axes, right? You've got growth, just think of economic activity, high or low. So you can have positive steady growth, the positive rapid growth. You can have negative growth or low growth. And then inflation, are we in a high inflation environment or a low inflation environment? And as those 2 economic factors interact, you get these 4 quadrants, right? High growth, low inflation. Think of that as an economic environment of high prosperity. You could have low growth and high inflation. Think of that as the economic environment of stagflation, really harmful economic environment to most portfolios. But the different asset classes that I showed on the previous page fit into these 4 different quadrants, these 4 different economic states, so that you can construct a portfolio that can do reasonably well across all different economic regimes. So think of growth and prosperity, right? Equities being the primary one. Corporate bonds will do well there because the risk of default is low, and you've got low or falling interest rates. So it's going to help on the interest rate side, which would cause the bonds to increase in value. Emerging market debt. Emerging market economies are sort of levered to developed economies. And if global growth is doing well, you'll have emerging markets doing well. Infrastructure, mortgages, government bonds, real estate, commodities. So all of these things will do well in varying degrees in a growing economy. So let's go to the opposite side, right? A really bad economy where you've got rising inflation and falling falling growth. So inflation-linked bonds, that is Treasury inflation protected in securities tips, they ratchet up in value as inflation rises, and as rates are falling, they will benefit from a falling rate environment as well as bonds. So tips would be the primary beneficial asset class in a stagflationary environment. Commodities, right, are linked to inflation. Infrastructure and real estate both ought to do well in an inflationary environment. So not a ton of assets that could protect you in that environment, but their assets exist nonetheless. And then you look to the other two regimes: high growth, high inflation, and low growth, low inflation, sort of a recessionary environment. And you can see sort of intuitively what makes sense in those environments as well. The point being that you don't want to just invest for growth and prosperity. You want to have a little bit in each one of these quadrants. So what is the primary factor that makes diversification work? And pure and simple, it's correlation. It's the way that different asset classes move relative to one another. And correlation, as we've talked about before, but just as a refresher, the correlation metric can be measured between -1 and 1. Two assets that are perfectly negatively correlated with a correlation coefficient of -1 will move in mirror images of one another, right? When one is up, the other is down, and they act in perfect negative lockstep. And then on the other end of the spectrum, an asset classes with a correlation coefficient of 1 move in perfect lockstep with one another. No diversification benefit. So -1, perfectly negatively correlated, great diversification benefit. 1, no diversification benefit. Practically speaking, you can't find assets that are perfectly negatively correlated, which when you put them together give you a positive expected return, right? They would just essentially cancel each other out, and the return would be 0 theoretically. So this shows just illustratively how different asset classes move through time differently, and then when you put them together, you get reduced amplitude in the volatility of returns, right? So the ups and downs are lower because you have these asset classes that move differently relative to one another. And then here is an example of a table of how asset classes are correlated. And you can see there's no asset classes here that are hugely negatively correlated. You have some that have some negative correlation. And this is just a snapshot in time representing, the mid-90s up to a few years ago. And you have private real estate and private equity that are very lowly correlated with bonds. You have private real estate and stocks lowly correlated. So real estate becomes a pretty good diversifier. And then the standard is stocks and bonds, right? And so you can see how bonds would be the key diversifying asset relative to stocks, very liquid, public markets, easily valued, and lowly correlated with stocks. So that's why you see sort of a 60-40 portfolio as the minimally diversifying portfolio. And then here is sort of a messier chart of the one I showed you earlier, which reflects historical reality of adding stocks, bonds, and real estate together. So you can see the colored lines reflect stocks, bonds, and real estate. And, they move all over the place. Naturally, you see the amplitude of the return stream being higher with stocks. Bonds is relatively steady, but there's been some volatility in bonds as interest rates jump around. And real estate, interestingly, it's not valued on a daily basis. It's valued quarterly. So you get a little bit lower volatility there. Some sort of false diversification benefit, but it is additive to the overall diversification of the portfolio. And then you can see where when you pull them together, the black line in a 50 stock, 40 bond, 10% real estate portfolio. So you're only adding 10% of new diversifying asset class, real estate. You can see how the volatility is reduced, that the amplitude of that line is reduced. It chops off the lows, it chops off the highs, and just demonstrates the benefits of diversification in reducing risk or volatility in the portfolio. So this chart takes a little explaining, but if you can get this chart, this really demonstrates that free lunch concept and shows the benefits of diversification. So here we're talking about the efficient frontier, right? The efficient frontier is a curve or a line on a chart that represents return on one axis and standard deviation or risk on the other, right? This is volatility, how volatile is your portfolio relative to how much return you're getting for that portfolio. And the higher return per unit of risk means that you're getting a more efficient portfolio. So let me walk through this, right? You got two asset classes. You can think of it roughly, illustratively, in terms of class A would be stocks, higher returning, also higher risk than bonds. Think of class B as bonds, lower returning, lower risk than stocks. And then, so what happens, right? So let's say we're starting with a portfolio all at 100% in asset class B, right? So we're going to get about 5% return and about 15% standard deviation or risk. And then and this number here represents the correlation coefficient. So what did I say? A correlation coefficient of 1, they're perfectly correlated. And so as you move from asset class B, now you're reducing asset class B in favor of asset class A. So you go from 100% of the portfolio in asset class B, and then you're decreasing asset class B, increasing asset class A with a correlation of 1, meaning they move in lockstep with one another. It's really just a straight line change in terms of return and risk, right? So there's no diversification benefit all the way till you get up to asset class A, and then you have, it's about, what is that, about 17% return, about 20% risk, okay? So now what happens? Let's say we've got a correlation coefficient of 0.3. So not negatively correlated, but with 0.3, and this is roughly a stock bond correlation over time, you are, as you go from asset class B and you add asset class A, even though it's a higher risk asset, you're adding it in, and because it moves differently, the curve is bending backwards here. And this is the magic in the mix, as I like to say. You're getting a higher return for less risk, even though you're adding an asset class that is riskier. And it's because they don't move in lockstep. So it's that correlation coefficient that gives you that free lunch. And so let's follow along the curve, right? So we're bending backwards, more return for less risk, until we reach a point where the risk in asset class A is going to now overwhelm the risk in asset class B. And so now we're still getting more return, but we're moving back up the risk curve, increasing return and increasing risk. But notice that the slope of this line is quite a bit lower than the slope of this line. So for each unit of return that you're adding less risk than if they were 100% or had a correlation of 1. So continuing on, now we've got an asset class that is correlated at -3, so really good diversification benefit. And so it bends backwards even further before it starts up, and then the slope of the line is lower. And then with a correlation coefficient of -1, perfectly negatively correlated. We can take it all the way back to, as I mentioned, a zero risk with a positive return. Totally theoretical, does not exist in investing reality. And then the last point I want to make is the point from the lower X to the higher X is the free lunch, right? So why would you be up here, or sorry, why would you be down here at a low return for any given unit of risk when you could be up here just by adding some more of this riskier asset class? And it's the same all along the way, right? So this line is the efficient frontier. It's the highest amount of return you can get for any unit of risk. And you essentially cut the efficient frontier off before it starts bending backwards on the lower end. Because you wouldn't want a portfolio that has a lower return for the same amount of risk. So this is the same concept, sort of just more illustrative. There's a lot of portfolio mixes that are below the efficient frontier, right? That you could come up with. You can create you can create a portfolio that gets you at any point on this chart. But why would you be down here when you could either be up here with a higher return with the same amount of risk, or over here with the same return for a lower amount of risk? And that's the idea behind the efficient frontier. You want to be on it or as close to on it as possible, given a reasonable asset mix. Okay, so these next three slides, I've just taken real data and I've added the three what I call primary diversifiers or additions to the portfolio, to a 60-40 portfolio. The first one is real estate, and we've talked about a little bit. And this is just practically what happens when you add real estate to a 60-40 portfolio. And in this 60-40 is a global equity 60-40. So we're taking global equity, US bonds, and adding real estate. So the couple of interesting points to make here. First of all, the max drawdown relative to just stocks is lower. Relative to a 60-40 is lower, right? So that's a diversification benefit right there of adding real estate to a 60-40 portfolio. And then, I've got some return data over here, but it's summed up nicely in this chart down here. This is the same chart that I used to demonstrate the efficient frontier. It's return and risk. And so where do you want to be, right? You want to be ideally up and to the left, but this demonstrates you just by adding real estate to the portfolio, you can get the same or very similar return with less risk. So this is historical data that shows the benefits, diversification benefit of adding real estate to a 60-40 portfolio. Private equity, so same thing, right? You look at adding private equity to a 60-40 portfolio, and you can see relative to stocks, the big drawdown, relative to the 60-40 here, adding private equity, reduce the max drawdown. So, and I'm sorry, by max drawdown, I mean the biggest loss during the period. And then here, it actually went from the 60-40 up and to the left, right? So kind of the ideal outcome, at least during this period. So lower risk, higher return. And then this is hedge funds. And hedge funds, as most folks may remember, hedge funds has had kind of a tough run, certainly hasn't kept its original promise of being stock returning with bond volatility. But we believe that it still makes sense in a diversified portfolio. You guys are using it in that framework. And you can see here, first max drawdown, a little bit less, not a huge benefit there. And then with respect to the 60-40 portfolio, it looks like you're on the upper half of that efficient frontier, not providing a ton of free lunch, right? So lower risk, but a little bit lower return, at least through this observation period. And that concludes my formal comments.